Hi everybody, my name is Toby Amis. I head up developer workflows for Refinitiv, and welcome to our inaugural Ask the Experts panel discussion, with today's theme being environmental, social and governance data, or ESG data as many of us will know it. A warm welcome to everybody on the panel. First news of the day, unfortunately Sally Eves, who was due to join us, has been unavoidably somewhere else. She's unable to make it now, which is a real shame, but we will catch up with Sally on one of the expert panels in due course. Welcome to Leon Saunders-Calvert, who is the Head of Sustainable Finance, LIPA and Investment and Advisory Insights, and a wealth of knowledge in this subject area. So delighted Leon can join us today. We're also joined by Andre Chanava, who is the Director of Product Management. I know Andre has been laser focused on ESG data for over 10 years, so it's a real pleasure to have him on the call. Now, commingled with that expertise of the domain, we have Alex Putkov, a developer advocate at Refinitiv, and I know he's been working alongside Gurpreet Bahl, another developer advocate at Refinitiv, with the ESG data set. And we plan to talk about ESG on a number of different levels. This is really supposed to be an interactive session. At Refinitiv, due to the COVID-19 challenges we all face, we were striving to try new formats to engage with our audience and the developer community and the business community in new ways. And so having a live webinar with an Ask the Experts, from the ability to ask questions about the code right through to the domain, is, I think, something that's really interesting to us. So please do use the chat facility. We've had questions coming in advance, and these are centered around transparency and standards across the content, the shifting nature of disclosure and their distribution, sustainable development goals and how they can shift investment strategies, and are companies holding themselves to account and driving high levels of ESG transparency, of disclosures, and how do they perform versus companies on the other end of the spectrum. So we'll be focusing the conversation around these areas. There are some questions that came in later yesterday as well, which we may well get a chance to look at too, I hope so. But please do feel free to jump in with any of your questions. Now, in the spirit of making this truly interactive, we'd like to ask you some questions. So we're going to ask you a series of questions and polls, which I will bring up in due course. This will really help us to understand our audience. It will really help us to understand how to pitch some of the conversations, some of the questions, etc. So let me just get my control panel up in my slides. Okay, so the first question is, which country are you from? Where are you dialing in from today? We're really interested to know what kind of reach we're getting with the channels that we've promoted this on. It's only a short list of countries. If you don't find your country there, it's based on actually where we've seen registrations. If you don't see your country there, just click on the other and we'll know all of your information anyway from the On24 platform. That also is the same case for some of the questions. If we don't get a chance to cover any of your questions, we will certainly be coming back to you. Certainly Alex and Gurpreet and others within the developer advocacy team are really keen to work with any customers, any kind of use cases, be they ESG or other. So keen to keep working with you in this way. Let's hope that we've had some replies to that. And United States, 26%, United Kingdom, 29%, Canada, Germany, none in France, South Africa, great, Spain, and lots of others as well. So I look forward to finding where those other countries are. Okay, great. That's great to get this kind of engagement. Let's carry on. So the next thing I'd like to ask you is, do you use ESG data today? Obviously, I'm going to pause because I want to catch as many of these answers as we can. ESG is a really hot topic. Not everyone is using it. Some people argue as to some of the validity or whether it restricts their investment strategies. These are some of the things that we'll come on to in due course. So let's hope we've got some feedback on that to steer us further. Wow, interesting. So, yeah, broadly 50-50 split. So that's really, really interesting to know. So for the people who've used ESG data today, I'm quite sure would love to hear your questions around some of the challenges, some of those that we'll throw out during this session. And for those who haven't, please chip in. You've got Leon, you've got Andre. They really do know their stuff. And you've got Alex and you've got Gurpreet. The technical questions, we can cover those as well. So moving on. So for those, I guess, maybe not just for those who use USG data, maybe you don't use ESG data because you're in the second camp of this multiple choice question. So do you consider ESG to be a good tool for investment decisions, or is it limiting? So the first one really being, yes, it can help shine a light and drive my investment strategies. The second one being, it can effectively restrict my investment universe and therefore impact my returns. So that's right. So that's interesting. Above 70% think that it can help with investment strategies. That's where I would have hoped and thought it would be, but that's certainly encouraging. I'm sure Leon and Andrea are happy to see that kind of number come in. And let me see if there was one more. Yeah, so interested to know what kind of role most closely describes what you do. Now, I fully appreciate I didn't want to throw an exhaustive list of roles out there. I hoped to catch many of you with the first four. Otherwise, we'll have you in another bucket. And I'll give a few more seconds for that. That should be a fairly quick one. And then we will rapidly pass on to Leon. I'm really keen for him to frame this session for us. Leon owns this content set and is a real leader in this space. So I think it'd be very interesting for everyone to hear what Leon's got to say. And then we'll start getting more granular and we'll start to get through into some more, looking at some Jupyter notebooks to bring some of these things to light as well. All of which will, of course, be available afterwards to you or are already available on developers.refinitiv.com. Wow. Interesting. So 30% asset manager, 23 research, 13% developers, and others. I guess I won't ask the question, but I'm really keen to understand of the researchers and the asset managers and the quant analysts. I mean, I guess many of you also coding as well, but maybe don't identify with being developers per se. Not that this is all about coding, but that's a really, really interesting. The rise of the domain expert who has technical prowess is something that we really believe in at Refinitiv. Okay, so Leon, I'm keen to hand over to you to, really just, set the scene. We've asked a number of questions. You've seen a number of the replies come back. Tell us more about ESG. Give us an introduction to your role and ask for some high-level thoughts really on ESG as a discipline within investment strategies, as well as the content set strategic importance to Refinitiv. And any sort of trends you see in demand for the data. What's your 5 minutes holistic view on ESG for us?
Sure, Toby, happy to. The danger is, of course, that this is a topic that I could talk to you for a very long period of time, and you know me, I do like to talk, so I'll be as brief as I can, and I'll just give this sort of holistic view as to sort of what are the trends in the market that we're seeing. We're obviously an important player, a major player around ESG data, corporate level data, as well as country level data, and provide that data to our customers, typically asset managers, but also investment banks and researchers, in order for them to integrate into their investment allocation processes. But look, I'll come on to that in a little bit. What are the drivers that are making this important? Why is this a particularly big thing? I think there are a few key themes that happen to coincide and drive drive focus around this space over the course of the last few years. One of which is a generational capital shift. As millennials start to actually get a hold of more capital and be able to invest that in pensions and savings, millennials are asking all kinds of difficult questions, which the previous generation didn't ask so much, such as, is my money being put to good work? And what's the purpose associated with the investment strategy for which I'm investing my money in? And of course, that causes all kinds of problems for asset managers and wealth managers who don't have good answers for those, or didn't have good answers for those, and need to start to come up with those kinds of responses. There's a general awareness, of course, in just the community at large, if you like, consumers as well as professionals, around issues such as climate change and in the post-Me Too movement, of course, over the last few years, expectation that people get treated equally in the workplace and so on and so forth. And so those issues start to become much, much more central to everyone's engagement with what business looks like. There is clearly regulatory overhang on the market. It is absolutely clear that regulation is coming. The first real form of that will be in the form of the EU taxonomy, which arrives at effectively the end of this year. But that is the first and not the last in terms of regulatory oversight that we'll see in this space associated with what mandatory disclosure looks like and the like. It's also, interesting enough, for the buy side, for those of you that are identified as asset managers or potentially even researchers, ESG is something of a really interesting opportunity for alpha generation. Obviously, the active management space has struggled to identify its value versus passive investing over the course of the last few years, and the growth of ETFs and the channeling of money into the ETF, into the passive space. But ESG and the use of ESG potentially allows for the ability for active managers to really be able to identify ways in which they can outperform and manage risk better and things like that. And then, of course, on the investment banking side, the financiers, the people creating new capital, are helping to raise and underwrite new capital. There's the requirement, ability, and opportunity to raise capital towards transition finance, transition to a low carbon economy, that kind of thing. So there's all kind of funding opportunities which the investment banking side, rather than the asset management side, wants to tap into. A couple more comments, very very briefly. So I think those are the sort of main underlying trends which cause this to be a really hot space at the moment. I would say there's two things which are growing in the market, and they're both growing in terms of assets under management. One is that there are now something like a third of assets under management which in some way identify themselves as values-based investors. In other words, they identify themselves as wanting to drive outcomes in addition to financial returns. They identify themselves as ESG in some way, shape, or form. Might be climate focused, might be diversity inclusion, might be ESG as a whole, but in one way or another, they've identified themselves as having an investment strategy which drives outcomes, which is more than just financial returns. That's an enormous proportion of assets under management and growing very, very quickly. But even for all the others, and I think this is the really important thing here, even for all the other assets under management, all the other investors who are focused purely on valuations-based investing and making sure they deliver return on investment for their investors, there is a growing understanding of the need to, I guess what I describe as internalize some of these external risks and opportunities. And that actually integrating ESG and certain types of ESG data into the investment process is not just good for driving sort of social outcomes for those ESG investors, but actually it helps you manage your valuation and returns risk, and indeed identify opportunity, completely independently of whether or not you're trying to drive, social good, if you like. And I think that a very obvious, a very good example of that is the focus on carbon-intensive industries and enabling the transition of companies in carbon-intensive industries to decarbonize, so that they don't get left behind in a decarbonizing economy and become a stranded asset. Whether you, so to speak, want to drive positive outcomes or not, you don't want to be invested in a stranded asset, which is going to be worth nothing in 10 years' time. And that is a valuations-based issue as much as it's a values-based issue. So I think, look, those are some of the sort of kind of key things that we're seeing in the market. The reason why this is so central, the reason why the data in this type of space is so in demand. And of course, delighted to, work with Toby and the team and with the market to think about different ways in which we can help identify correlations between ESG data, performance data, risk, all those types of things, some of which we'll touch on, I think, during the course of this webinar. So, Toby, with that, back to you.
Well, I'm going to come quickly back to you because, interestingly enough, one of the questions that's come in from Matt Reynolds was, do you believe that disclosures are going to be mandatory for public and private companies? And do you believe mutual funds are going to have to report? Now, these are some of the things that you opened with. So I thought that we'd just sort of piggyback onto the end of your comments and get your view. And then maybe even, Andre may have a particular view on that as well. I think that for me, that seems to be really key in this space, right? Transparency and regulation.
Yeah, so I could do a very long-winded answer to that, or quite a short one. So look, it's absolutely clear that there is mandatory disclosure coming, and the EU taxonomy is the first form of that, requiring disclosure of where you make revenues which are green, if you like, versus those which are not defined as green. And indeed where you deploy OPEX and CAPEX within your company, which meets those criteria in that taxonomy. So that's a good example, but it won't be the last. I do expect that there is a growing requirement for mandatory disclosure around certain data points. The challenges are not insignificant, though. There are challenges around mandatory disclosure probably needs to look different for different industries. Different data points are more important for different industries. If you are an oil and gas company, in a carbon intensive industry, carbon emissions disclosure is probably central to what people will expect from you. Whereas if you are in the social media space, that's probably less important. But cybersecurity risk disclosure around how you're managing your policies in that space becomes very, very material. And so what good disclosure looks like probably looks different between different industries. Not to mention, Of course, you've got different regulatory bodies who will apply probably slightly different rules to each other in different regions of the world. So that's not a straightforward process. It's not a quick process. And I don't think there'll be immediate alignment globally, but it is happening. It will happen. It's just a question of when.
Thanks.
I won't go into more detail than that for the time being, but it's a great question, and I'm happy to follow up if that's useful.
Great, Andre. Let's bring you in. I'm keen to understand more about. I know sustainability generally is something you're very passionate about, and I know that you're looking at ESG and sustainable development goals in your research and to drive your research. What do you think are the advantages and maybe even the pitfalls of this kind of approach? What's your thoughts around sustainable development goals? And then we'll come on to another question to the audience after that.
Yeah, so myself and a few colleagues, we spent quite a bit of time meticulously going through each of the SDG metrics, which they're super detailed. And we went through an extensive mapping exercise against the macroeconomic time series database that we have called DataStream. So we have one of the, a wealth of millions of different time series available within DataStream. And I think one of the challenges with the SDG metrics that I've encountered is just how specific and how granular they are, and how hard it is to get one-to-one mappings with some of those SDG goals. It's and we're using like over 10 different sources, I think, at the moment, in order just to get a picture which is about 30-40% complete on the SDGs. And again, maybe we're being a bit harsh on ourselves because we're scoring ourselves like a partial match for some metrics versus a direct one-to-one map. But yeah, so the actual just the nuts and bolts of actually tying it to the series that we have, and then that's a challenge. So disclosure's one. The other one is, of course, at a country level, some of the sources we're using, they're excellent in terms of comparability, standardization, etc. But the timeliness of the updates could be better. For CO2 data, for example, we're looking at maybe 2014, 2015 as the latest available. So there are challenges around that. That said, we feel like we've got something that is a stake in the ground that gives you a lens and that is simple and easy to understand at a country level. So yeah, I'll stop there.
Great. So there's a question up on the screen for you there. So what do you all think about Sustainable Development Goals? Can portfolios be improved in terms of Sustainable Development Goals without significantly changing the performance in terms of return, variance, or diversification? What do we think?
Yeah, it's a good question. I think, it's interesting, right, how individual companies are approaching the SDGs. Clearly, there are some very specific things within the SDGs that companies are aligning themselves to. So we've seen that, for example, Enel, the Italian utility company, issued a SDG linked bond, which was tied to emissions and also renewable energy capacity. So this was really, really interesting to see. But whether, there's something that looks at, all of the factors that go, all the metrics that go into the SDGs, unlikely. You could say it's maybe not relevant as well. But it's what we're seeing, or what I've seen so far, is a very specific handpicking of specific SDG criteria at the moment.
Yeah. Great. I am seeing some of the questions coming in as well. We will come on to them in due course. Let's just move forward to see what the audience are thinking about this. Yeah. So yes, no, unsure. So broadly ambivalent or positive. So it's interesting. Okay. So let's move on. Before we do, we will come to the questions within the chat. There's some interesting things coming in. And Andre, you've given us your view on that. I'm quite keen to understand sort of our data coverage, including, just a little bit of an explanation as to, what's the basis of the way that we our metric methodology. I mean, you talked about some of the challenges already, but if you could just talk about, some of the basis of the way that we do this to maybe help educate some of the folks on the line, and then we'll some more details with some working studies.
So I'll just throw out some numbers to get started. So we have a universe of 8,800 publicly listed companies. It represents about 80% of world market cap. We measure companies against more than 450 individual measures. We use some of those measures to calculate analytics or scores, which are computationally driven. They're pretty straightforward. So we have over 180 individual scoring measures that roll up into 10 categories that then roll up into 3 pillars. And then we've got different variations of overall scores. And then the other dimension to our data set is that we have history that goes back to fiscal year 2002. So we've got a long tail of history, maybe the longest in the industry. So that's just some high-level stats as to the numbers, but all of these numbers can't actually happen if it's not for the 100+ analysts that we have working, very hard behind the scenes in the different content operations centers that go through the publicly available data that they're, carefully standardizing and cleansing. So that's really, yeah.
Of course, that's one of the huge valuable things that Refinitiv does with a lot of data is the value add on top, and some of that is much harder to do than with others. And certainly something like ESG data takes an awful amount of processing. And that's interesting. One of the questions that has come in is effectively around that, and I'll pull up the details. A lot there, but it's really about saying, should I think it's probably, I can see where the answer will come from us, but, you have companies who are investing a lot of money to do this for themselves, and there's lots of providers out there. Where is the right place to find your answers, or is it a case of checking across different sources? One of the questions is noted that there's not a huge amount of correlation between some of the ESG metrics across the different vendors, which of course, as if I imagine myself as an end user, might make me then want to invest some time in producing my own kind of number crunching, my own metric. What's your thoughts around that, Leon or Andre?
Yeah. So, look, a couple of things. I think that we've talked a little bit about the lack of standardization, lack of standards. That includes a number of different things. There isn't a set standard for instance, if you take some data points that are really important to ESG. I've used a couple of times already the example of carbon, so I'll carry on because it's pretty, it's pretty pertinent, but it's certainly not the only thing that the ESG is about, but just use it as an example. Reporting on your carbon emissions is actually, there's not a consistent way that everyone has to do that. So you don't actually know whether or not the same data point, carbon emissions scope 1, for instance, is the same for every country that reports that same data point. So you haven't got standardization at that level yet. You also haven't got standardization, as we already discussed, around mandatory disclosure. And so different companies disclose what they think is most important, or indeed what they're under most pressure to disclose based on pressure from their investors, more often than not. But either way, there's no mandatory disclosure levels. So it's not entirely surprising, given the fact that there's a lack of standards in the data, that you then end up with, as well as the fact there's lots of qualitative input often by a lot of different data providers or information providers, insight providers, researchers, qualitative input about how heavily one should measure one data point against another data point, et cetera, that you'd end up with a degree of difference in terms of the outcomes around ESG scores between different providers. And indeed, whilst there is some value in I may even question whether or not there's a lot of value in all the different systems coming up with the same answer. The fact that we've got ratings agencies which tend to correlate very, very highly together didn't particularly help us during the credit crisis. So there's some value in cognitive diversity here, I might suggest. But I also realize that there is a challenge for just consumers in being able to understand, well, which one should I really use? I'll talk very briefly to, how do we think about scoring? Andre's talked a little bit around the fact that it's computational, and that's really important. There's not a subjective, opinionated process that we work through on our side. We take the data that we have on companies, we compare different companies to each other based on that data, and the scoring comes off the back of that. So it's essentially a relative-based scoring methodology. But it does need to reflect a couple of really important nuances, which are very specific to ESG, including this issue of materiality. And materiality is central to any conversation you have around ESG, which effectively means not all data points are created equal. I talked about this a little bit earlier, right? Not all data points are equal for all different industries. So how do you determine that? And Refinitiv uses our own data in order to understand the relative weight of data points. So, for instance, you can take the total carbon emissions in our database across all companies, and then we can segment that out by various different industries, and then you can understand how much each industry contributes to total carbon emissions, and that then reflects the weighting for that data point of companies in those industries. So we use the data to objectively tell us the story about what's important and what isn't, as opposed to subjectively opining. I don't want to imply it's the only way to do it. We think that's the best way. We think it reflects the Refinitiv values, the way that Refinitiv provides transparency to the market, drives transparency to the market as a market data provider. But the fact that others provide a more qualitative overview on that, well, I'm sure that has value too. And it's up really, quite frankly, to the end users, the investors, to really understand, make sure they understand the methodology of where these things come from and how well they reflect their own investment strategies. Neither Refinitiv nor any other data providers are responsible for the actual sustainable investment strategies that the investors or the investment bankers might have. And indeed, you need to make sure that you understand really what it is that helps you, with that decision-making process. Long-winded answer, but there you go, Toby.
That's great, thank you. We've asked a question. So consistent, transparent reporting will lead to standardization and increased adoption of ESG investing. Let's see what people have come back on that. Strongly agree, unsure, disagree. Very interesting. And in line with Leon's last comments. Okay, let's come on to one of the questions, because Gurpreet has actually got one of our Jupyter notebooks running using the Icon Data API, where he, I think, has kind of gives you some insight to this. So this question is from Dipanita: how ESG scores will help to improve the financial performance of companies? So, Gurpreet, you've done a little bit of research around this. Are you able to sort of give us a glimpse into, some of the initial sort of findings that you uncovered? And then I think after that, one of the things that will be really interesting and pertinent is that there's also work been done that we've brought to life for the Icon Data API on disclosures. And so we're able to see the distribution of disclosures from 2002 outwards, and you can really demonstrate the number of companies now who are disclosing, which obviously, as we've just heard, is paramount to being able to rely on and compare ESG metrics. So, Gurpreet, if I can hand over to you to share your screen and just run us through your notebook, which looks at high-scoring ESG companies and their performance.
Thanks, Toby. I just shared my screen.
Fabulous. Let's just wait for it to come into the live view. Fantastic. There you go. So the question was, can ESG generate alpha? I think let's have a look what Gurpreet finds.
All right. Are you able to see my screen now?
Yes. Yeah.
Okay. So earlier one of the poll questions was, can ESG really help your portfolio? And many of the audience answered as unsure. I hope this can sway them in one direction or the other. Basically, this was an exercise when you yourself and Andre suggested that maybe we could take a look at the portfolio performance where the constituents are high ESG rated companies. And this is exactly that Jupyter notebook. It's a Python Jupyter notebook. It's available on our GitHub sample site, and we'll include the link to that in the end. So what it does is, I'll just quickly walk through this notebook and try to execute it, but it's long running, so I'll probably skip to the results at the end. So what I'm doing in this particular notebook is try to get the performance data for an index, in which, in this case, it's the Standard & Poor 500 index for last 6 years or so. And this is what happens. So this is this Jupyter notebook is using Icon Data API, and as some of you might be aware, that Icon has an API. You can use Python libraries to get it. And right now I'm connected to Icon, and I'm pulling the ESG data using the Jupyter notebook. So this is the performance data for the S&P 500 for the last 6 years. And here, let's quickly go through this and start this. So here I'm trying to get, for each year, I get the index constraints. In the first line, I get the index constraint with their ESG score. And this is a consolidated score, and I'll let Andre talk more about this, how it's calculated and other things. But then once we get the list, we get a subset of index. And the subset is every company that has an ESG score greater than 70%. So the score varies from 0 to 100. It's a consolidated number. And we get the highest ESG scoring companies. And for those companies, that subset, we get the close price, which is the performance data for that subset only. And once we get the performance data for that, we consolidate it and sort of normalize it. And in the end, what we do is plot that data. And this is what the plot looks like. So here, starting from 2014, this is rebased to 100. The index has gone up. It's 172 right now, so 70%. But the subset of the companies which had the ESG score greater than 70 has gone up significantly. It's like 420. So this is a very simple exercise using icon data API, and all it's doing is just getting a subset. So essentially getting the alpha from the index.
Very, very interesting. Now, let's have another look at some of the questions. Oh, wow, this is incredibly topical as well. How are you thinking about country ESG reports? How are you at Refinitiv doing this? We've actually, let me share my screen, because we built a Jupyter notebook for this 2 days ago. And whilst I pull this up, maybe Leon or Andre, you want to talk about the challenge of country level ESG scoring, and I will pull up the article.
Yeah, I'm happy to jump in here. So, so what we've done is, I mean, we put a stake in the ground, and we started off with just a fairly simple Excel model that does the computation all within there based on latest available data. But the intention will be then to iterate off that and then actually have the scores stored and calculated in a database of record with point in time and so forth. But we're using simple percentile rank calculations at the moment against the universe of countries. And we didn't want to give the sense of false precision by just publishing the raw percent rank scores. So we decided to use a points conversion table and allocate up to 10 points. So depending on which decile the percent rank is, we give 1, 2, 3, up to 10 points, and then aggregate those across each of the SDG goals. And then we do a median across all of the 17 SDG goals to get a combined rank for the country. And so far, it's proven to be pretty accurate with external research, and that's widely available on SDG rankings. So it's been a promising start. And here, what my colleague Jonathan has done in that, Toby is sharing, he's actually taken that same template and actually coded it in Python, talking to the data stream API. And so literally recreating one for one.
Yeah, so let me just scroll through the code and show you the results, because I'm sure that's really, you can see your top and your bottom, but then we've got the distribution. I'll just zoom in on that a bit and let you carry on.
Yeah, so there's like 210 countries that we're using within this sample. Not all of the countries in the full list we use to calculate a score, because we do have thresholds that we're looking for in terms of disclosures. So the actual full list is a bit smaller than 210, but we've engaged with various customers around this, and it is available in our icon template library. So all our icon users can have a play around with it. And
it's both available as an icon template within Excel, and now hot off the press, Jonathan, and thank you for that, Jonathan, has just published this as an article. The code is on GitHub. So if you want to be able to look at country level ESGs and SDGs, then the developer portal may be the place for you. So that's great. Let me stop sharing my screen. One thing I am keen to come on to is we talked a lot about disclosures, and I am going to go through all of the questions in about 4 or 5 minutes. So, Gurpreet, can I ask you to show Alex Putkov's article, which shows the increase in disclosures over time of a universe of companies, because I think that's really interesting and certainly shows fantastic progress, but lots to do still.
While Gurp is sharing his screen, maybe I'll talk for a minute about why I decided to look at the distributions. And Gurp, let's show the notebook with the evolution of the distribution and the histogram of the distribution between 2002 and yes, this one. So there are many ways to look at the ESG data, and the ESG scores themselves, while they're very useful, and I'm sure increasingly more important role in the investment process, there's also a consensus that they don't tell the whole story. And a more sophisticated ESG investor may want to look at the individual metrics and combine them in some way and produce their own ranking or scoring framework, which is actually what many investment houses do today. And in order to do that, you really need to understand the data set. And one angle at which one can look at it is we have about 450 different metrics. Here I took the subset. I included metrics that include controversies and that kind of stuff. I took a subset of just under 400 metrics, and I split them between what I would call performance metrics and policy metrics. And sort of the rough definition of it is a policy is kind of a Boolean metric, whether a company has a specific policy, such as water usage. Or not. And the performance metrics is where the company reports its performance against a certain target, like CO2 emissions. It's not quite all that trivial to split the metrics in these two, and the reason why this is done is twofold. One, there is a hypothesis that performance metrics may be more important than policy, because what does a policy tell you if it doesn't tell you how the company does against that policy that they have? But that's just a hypothesis. And the other is purely technical. In the database for policy metrics, you can find the value of true, false, or null. And a null value obviously doesn't constitute a disclosure if you try to calculate the disclosures. But the false for policy metrics also doesn't constitute a disclosure, because no company ever reports that they don't have a specific policy. Whereas for performance metrics, a Boolean false value may constitute a disclosure. It needs to be counted in. So just the counting methodology is different for these types of metrics. So this chart that you see on the screen, it shows the evolution of the distribution of disclosures by companies. So the number of disclosures versus the number of companies that have that many disclosures. In 2002 and the latest, and the universe that's used here is the original universe of ESG coverage we had since 2002, which is about 650 companies. And as Andre said, now our coverage is over 8,000 companies. You can see a very strong progress in the number of ESG disclosures. You can see a very, very strong shift to the right in the number of disclosures that the companies provide. However, we're still a very long way. There's still a very long way to go. Gurpreet, if you could switch to the article and show the scroll down and show the this chart. It's a little bit hard to see. Maybe could you zoom in on it?
Maybe, yeah.
Right. So in this study, I took the constituents of MSCI ACWI index, arguably the most popular all-world stock index. So it has over 3,000 constituents. And this chart shows the number of disclosures, or the percentage of the companies that disclose a specific metric. And you can see that there is a very, very long tail of metrics that few companies disclose on. And Garp, if you could scroll down to the next graph. So here I break the companies into buckets. The number of metrics into buckets. As you can see from this chart, more than 40% of the metrics have less than 20% of the companies in the MSCI CWI index reporting on them. So that tells the story that many of the metrics are maybe industry specific, or you may want to discard them from your investment analysis altogether because they're insignificant. And that basically plays back to the point that not all metrics are born equal. And some are more important than others. Well, in some ways, this is kind of a naive study, and it definitely needs a much deeper look if you're actually going to use this information in your investment process. But Gerb, if you could scroll all the way down. Playing on the significance of ESG data for the investment process. In this case, I'm not looking at the ESG scores at all. I'm not looking at the polarity of the metrics. I'm only looking at the number of disclosures. And even for the number of disclosures, what I see in this chart represents, so I took the universe of large US industrial companies. And for that universe, or from that universe, I took the top 20 percentile and bottom 20 percentile on the number of ESG disclosures. And I looked at how these companies do financially. And what we see in this chart is that the number of ESG disclosures doesn't seem to have any material impact on the stock price measured by alpha or by the Sharpe ratio. However, you can see a very strong influence well, that's not technically a statistical correlation, but there seems to be a relationship between the number of ESG disclosures and company profitability metrics such as return on equity or return on assets. So I'm a bit conscious of the time. I could also talk a lot more about the distribution of the disclosures.
That's a great thing everyone's really passionate about. This is great. I'm really keen to spend the last 10 minutes trying to race through some of these questions that everyone's taken the time to send in. So I'm going to do that now. Whomever wants to chip in on this, Leon, Andre, Alex, Gerp. So from, is it Slevin? Do you feel TCFD gives a more broad view of climate risk than ESG alone? Similar, I like the detail of the EU taxonomy, as I feel ESG is seen as a sideline issue within companies and doesn't fit right under the CFO or CEO. Leon, I expect you might have a view on this, maybe, or Andre?
There are two questions in there. They're both quite broad and they're both different from each other. So let me sort of attempt a very simple version of each of those. So look, TCFD is obviously designed specifically for metrics and data and disclosures and standardization around climate-related issues. ESG is, of course, much more broad than climate-related issues. Climate is one element of the E of ESG. It's not even all of the E of ESG, right? So ESG is much broader, includes a number of other things. TCFD is, of course, designed specifically for that climate output. I think it's fair to say that climate is probably the single biggest thematic element or issue, theme within ESG, and clearly requires enormous amounts of focus and attention. So to that end, of course, TCFD I think is important, is necessary, and drives the kind of level of focus that's required to solve for that very particular problem. I wouldn't confuse it with ESG. It's not the same thing. It's a constituent thereof and a really important part of it. Look, I think the second question is very big and broad, and I think it is massively dependent on the company. So if you're an organization who will have to go through a completely profound change, a complete transformation over the course of the next 2 or 3 decades as a result of the likely regulation, carbon tax and other regulation that's going to come into effect if you're in a carbon intensive industry, that is not a job either for the CFO or, quite frankly, only the CEO. That means the company will have to completely change its entire operations over the course of 2 or 3 decades. It's a profound change and it carries massive risk. And of course, the only reason to undertake a risk that significant is because the risk of not doing it is higher. It's not, so to speak, altruistic behavior. That is self-enlightened, that is enlightened self-interest. For other companies that perhaps are in different sectors or have different types of operations, then perhaps a transformation like that is not necessary. In which case, the focus on where the company needs to focus its opportunity and manage its risk associated with externalities and how they internalize and quantify those externalities, what their impact is on the environment, what the outside environment impact is on them. The quantity or quantifiable elements of that may be much, much smaller. In which case they don't need to go through that total transformation. But there's not a single answer, I think is my point to that question, as to whether it's the CFO's job or the CSR job or the CEO's job. It depends on, quite frankly, the organization and what the externalities mean for them and what their impact are on the externalities. I don't mean to wimp out of the answer to that question, but there we go. That's a quick attempt.
That's great. I think... we kind of covered this one from Anastasia 10, which is really around not correlated ESG company ratings and should companies be looking to build their own. I think we kind of covered that already. We move on to Javier Vela. One of the main challenges... Sorry.
Toby, I was just going to say there's an important issue there, which is you can spend too much time focusing on correlation around overall ESG scores. Actually, Alex started to touch on this a second ago, which is some correlations may be very, very important, particularly if you're trying to manage very specific risks or indeed you're trying to generate alpha from specific capabilities, which are not ESG overall, but are elements within ESG. For instance, diversity inclusion correlates pretty well. Higher levels of diversity inclusion at the board level, at senior management level, tend to correlate pretty well to outperformance in the long term with companies. But that's not ESG as a whole. That's not the ESG score. That's the diversity inclusion quotient. So it's worth thinking about what you're trying to drive and what you're trying to manage as to where you want to identify those correlations and where the causal relationships are in those. Sorry.
No, that's great. I've just put a last question for the audience on as we get to the last 5 minutes. I'm going to continue answering questions. As I said, this is a brand new format, and we would love that you would agree that we can reach out to you afterwards to find out whether you like the format, whether it worked for you, what we could do better. And some of our CX researchers would do that if you are willing to. So if I could get you to consider that, and I'm going to move straight on to Javier Vela's question, which is one of the main challenges of ESG data is comparability. What is your view on reporting frameworks? Do you see anyone prevailing? Which is the most universal?
A big question. Well, look, I think that what you're seeing some clarity around some of the frameworks which are out there. There are some big ones. I think we can name them. I think everyone knows what they are. The likes of SASB, the likes of TCFD, which we mentioned earlier, the likes of GRI. But some of those are very specific, driving very specific outcomes. They're driving outcomes around a specific theme within ESG. We talked about TCFD being focused on climate as an example. And SASB is very focused on the accounting-based financial materiality of companies. And that might not be what an ESG investor is focused on. They might care about other outputs other than just financial materiality. So it really depends on what the sustainable investing strategy is that you have as to what is most meaningful for your outcomes. And unfortunately, neither we nor the framework providers can unshoulder the burden of your own sustainable investing strategy from you.
Fantastic. Right, let's, in the last 4 minutes, just see what we can do. If I don't come to your question, there's Matt, there's Monica, there's Priscilla, Eduardo, Jason, who works for me, so I'm going to ignore you for the moment. There's Fwong. We may not be able to come to you, but we will come back to you with all of these answers, and we will run other sessions like this. So, Monica Fitkova, SDGs are one way of framing monitoring, but they are largely qualitative. What about using the EU taxonomy for more quantitative benchmarks? That's number one. And there's another.
Hi, Monica. We know each other well. So
yeah.
Monica and I know each other well. It's a great question, Monica. And I think the answer is you need both. It depends what you're using it for, and both are useful.
Monica has another one, so as you already know each other, we'll let Monica have this one too. How will NFRD and TCFD impact efforts on data metrics and disclosure reporting requirements? We may have already covered that in some detail. I'll let you be the judge of that, Leon.
I've covered it to the degree that we can with the time that we've got left, but there's a much deeper conversation, probably for me to pick up with Monica afterwards.
Yeah, let's come on to Matt's question, because we had lots of engagement with Matt. And Matt and I have chatted a little bit over email, and I think is now connected to one of our dev advocates. Matt's question is an example of an SDG challenge. For example, here in Canada, our companies are being starved for capital by ESG guidelines, which forces us to use more oil from Libya and Saudi. Seems like the outcome, outsourcing to economies that have no restrictions in place, has backfired. Our companies have the most stringent extraction and remediation guidelines globally, but a devotee to the SDG would not be able to invest. How do we reconcile? What a brilliant question. Leon.
I can't do justice to the question in the time that we've got left, but it's a great question, and it focuses the attention on the supply chain. In the carbon space, that is scope 3, but carbon isn't the only important thing here, and indeed it's a focus on the supply chain of the company. And so understanding the supply chain of a company becomes critical in the process of wanting to understand, the impact of any given company. Indeed, that's why the likes of some companies making very, very aggressive statements about what they want to achieve in terms of their own ESG footprint includes what they want to achieve in their own supply chain, because they're recognizing the criticality of that, and the investors won't let them get away with just passing down those operations outside of their immediate control down the supply chain, without wanting to track that and understand that too. Really important issue.
Yeah, we've got 1 minute left. Fwong, Monica, Eduardo, Priscilla, Monica again, Hayet, Matt, Christian, there may be others. We will come back to you. Thank you to the majority. Are happy to have feedback. Check out our articles on developers.refinitiv.com. I'm quite sure this won't be the last of the Ask the Expert sessions. If you have any particular topics you'd want to cover, even if out of ESG, please drop me an email. And aside from that, thank you for what has been a very engaging hour. I hope you've got as much insight out of this as I certainly have, and I think Leon and Andre as well. Just hearing some of the questions come in, it's encouraging for me that they are really resonating with the kind of topics that we wanted to cover. So thank you very much from me, and on behalf of all the panelists and all of the audience for their engagement. Have a great morning, afternoon, or evening wherever you are. Thank you very much.